the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares slid today as investors continue to monitor renewed US-China trade fears. So if we look at the Straits Times Index, it was down 0.57% at 4,364 points at about 1:59 p.m. Singapore time, and that's with a value turnover of 1.03 billion Sing dollars seen in the broader market. Now, we do have the closing numbers right now, so let's take you through them. The STI ended 0.8% and the red at 4,354 points. In terms of value turnover, we are looking at 2 billion Sing dollars today, and gainers trailed losers 221 versus 430. Now, top advances for today, we've got for UF Point, Hua Tiong Global, and Valiance. And top decliners, we do have here DBS, GMHUSD, and iFast. Now, in terms of counters to watch, we have for you Mapletree Logistics Trust, and that is because the manager of Mapletree Logistics Trust yesterday announced that it has completed the divestment of an Australian property for 60 million Aussie dollars. Now, meanwhile, from how the MAS kept monetary policy settings unchanged for the second straight time in today's quarterly policy meeting to how silver prices touched an all-time high, we've got more economic-related headlines remaining in focus. And joining me right here in the studio is Abhilash Narayan, investment strategist at HSBC Global Private Banking and Premier Wealth. Abhilash, welcome back to the show.
Good to be back.
Great to have you. And let's start with global news this time around. We saw a rally last night on Wall Street because US President Donald Trump, he tempered his rhetoric against China. Earlier, he threatened China with 100% tariffs. So Asia tried to track that advance, later turned into the red. How would you read into movements relating to the US and also Asia today?
Well, yeah, the last few trading sessions have been quite volatile, and they're a good reminder that geopolitics remains an ever-present sort of factor to consider for investors. So, as you pointed out, stocks fell in US on Friday after President Trump threatened tariffs, and then rose last night once the rhetoric was dampened down. Now, in the morning session in Asia, stocks rose, but then they fell into red as China announced retaliatory measures, including restrictions on certain US-linked companies. And that has probably led the markets to recalibrate their expectations around the trade negotiations. And to be fair, it's not just Asian stocks which have fallen. If you look at futures markets, they do indicate that US stocks are likely to open lower, when they open this later today. Now, in the near term, we think that the trade-related rhetoric and noise could continue, especially as we head towards the meeting between President Trump and President Xi in the APEC summit in South Korea on 31st October. Now, if we do see any sort of sharp pullback in the markets, we would view that as a buying opportunity because we remain confident in U.S. economic growth, earnings expansion, AI innovation, and the impact of Fed rate cuts. So we are overweight on U.S. equities despite the tariff noise and expect the upcoming Q3 earnings season to reaffirm the positive fundamental view.
You talked about AI, and earlier overnight, in fact, we've seen some of the AI titans, NVIDIA, AMD as well, logging some gains. And tech firms, they remain in high demand, with the latest impetus for buying coming after Broadcom formed this partnership with OpenAI. Where tech shares in Asia are concerned, how would you read into movements today, and for how long can that optimism surrounding AI last?
Well, if you look at the announcement last night, it's the latest in a series of announcements we've seen of increased spending on AI and cloud-related infrastructure. If you look at Magnificent Seven companies, they are about to spend about $350 billion just this year on infrastructure, and that number is only expected to grow, over the next couple of years. And that investment is actually backed by solid demand. So, there was a Bloomberg report recently which said that the demand or the total market for generative AI is likely to grow at an annual rate of 43% for the next 7 to 8 years. Now, even if it's slightly slower, and let's say 30%, that's still very, very healthy growth rate. So, we continue to be positive on the prospect for AI-related companies, and we do see opportunities from AI adoption and monetization. I mean, we have started to see signs that, companies are reporting tangible revenue impact. So for now, we remain positive on technology and communication services sectors, but we think that it's important for investors to diversify their portfolios by adding exposure to high-quality bonds, gold, and from a sector perspective, diversify into financials and, industrials as well. Within Asia, we continue to be positive on Chinese technology sector, given the relatively reasonable valuations compared to US peers and the exciting innovation that's happening there.
And you talked about financials sector, banks set to report earnings in the US soon. But going back to the Singapore stock market as usual, Abhilash, how far did the STI track regional movements today, and any surprises when it comes down to some of the movers and counters to watch, like Mapletree Logistics Trust?
Well, STI was down, I think, around 0.8% today, which was much less than the drawdown we saw in markets such as Japan, China, or even regional markets such as Indonesia and Thailand. And given that Singapore is viewed as a more defensive market, this resilience is something in line with expectations. However, from a forward-looking basis, we continue to be positive on Singapore. So we are overweight on Singapore equities because we think that Singapore offers investors exposure to high-quality banks, property, and telecom companies. And, when you're in an environment where the Fed and other central banks are expected to cut rates, then the 4% dividend yield that Singapore stocks offer becomes increasingly attractive to income-seeking investors.
Okay. Now, staying in Singapore, we'll talk about monetary policy in just a bit, but advanced estimates from the MTI Ministry of Trade and Industry showed Singapore's economy expanded 2.9% year-on-year in the third quarter of 2025. What do you make of the latest numbers?
Well, actually, as you mentioned, the economic data was much better than expected. In fact, consensus was looking at around 2% GDP growth, and we got 2.9%. Now, if we drill down into the numbers, the upside surprise was largely driven by stronger than expected, growth in construction and services sectors, and also the resilience in manufacturing sector. So while the growth was lackluster, there was expectation that because of the payback of the front loading of exports this quarter, the manufacturing sector could see some weakness, but it was stronger than expected. Now, given the strong GDP print, we think that there is an upside risk to our 2025 GDP forecast of 2.8%. That's the forecast for this year. And next year, we are looking at 1.7% GDP growth for Singapore.
Okay. In the meantime, we do know that Singapore-based pharma firms which already have plans to build new capacity or expand existing facilities in the US, they are waiting for the confirmation that their plans will allow them to be exempted from US tariffs. Do you expect this in any way to weigh on growth in Singapore?
Not materially, because if you look at the impact of the pharma sector and all the construction of plants in US, I think this is well known. It's public news, and markets try to price this in advance. So if we assume markets are efficient, I think that should be reflected both in the valuation of the stock markets to a large degree and the economic estimates. So as I just mentioned earlier, we do expect Singapore's growth to slow down from current levels because of some cyclical factors to 1.7% next year, but that's still healthy when we think about the developed markets globally. And
at the same time, now off to monetary policy, the Monetary Authority of Singapore, MAS, kept monetary policy settings unchanged for the second straight time today. As expected, what are the levels to watch for the Sing dollar against other major currencies?
Yeah, as you rightly pointed out, the pause from MAS was widely expected. So they kept the slope, width, and the level of SGD near band, unchanged. Now, when we take into account the fact that, GDP growth has been stronger than expected, it's easy to understand why MAS is not in a hurry to ease monetary policy anytime soon. And when you look at their projection for 2026, they do expect inflation to rise moderately to 0.5 to 1.5% range. Now, from a currency impact perspective, dollar Sing did not move much immediately after the policy announcement, but it then started to test 1.30 level later on in the day. Now, from a near perspective, Singapore dollar continues to trade around 1.1 1.1% above the mid band. So it's trading on the expensive or the stronger end of the band, which in our opinion limits the room for substantial appreciation from here on. So we are neutral on Singapore dollar, and we expect dollar Sing to move towards 1.28 by end of this year and towards 1.26 by end of 2026, driven largely by the broad-based US dollar weakness.
Now, across the region, Abhilash, we're seeing Tokyo equities struggling there amid Japanese political turmoil, where the ruling coalition collapsed on Friday. Its junior partner Komeito quit the alliance. What does it mean for Japanese equity markets then?
Yeah, Japanese equities have taken a dent due to political uncertainty over the past few weeks, right? So if we take a step back, when the new PM candidate Sane Takaichi was announced, equities rallied, Japanese yen fell because there was expectation that she would like to implement a large fiscal stimulus package. And even back then, we had flagged that markets may be overestimating this impact from fiscal policy because she may not have enough political capital to push through these policies. Now, naturally, the recent developments, including the withdrawal of support from Komeito, has added to another layer of uncertainty. And in the near term, we need to see how this political situation evolves. But I think in the near term, Japanese equities are likely to see further stress. They could pull back. They could underperform Asia Japan equities. But from a fundamental perspective, right, there are a few positives. Weaker yen is supportive for exporters. The corporate governance reforms, which have been ongoing for past few years, have led to increased return on equity, increased dividend payout, share buybacks. So they continue to be supportive. So on balance, we continue to be neutral on Japanese equities for now.
And finally, before we let you go, Abhilash, we must talk about this one. Silver prices, they're touching an all-time high above 52 USD and 50 cents an ounce, as this historic short squeeze in London added momentum to a rally that's fueled by surging demand for safe haven assets. In fact, we saw a gold rush earlier as well. So what are the levels to watch for silver and gold? Again, the question, how sustainable is this rally going to be?
Gold and silver prices have been on an absolute tear this year. Gold is up more than 55%, silver more than 75%. And this latest surge that we've seen in both gold and silver has been driven by a demand for precious metals, given, the concerns around elevated global debt levels and the geopolitical risks, be it US government shutdown, resignation of French Prime Minister, and what's just happening in Japan. Now, in the near term, we think that, the rally is starting to look a bit stretched from a technical perspective. But, when we talk about gold and silver, let me take gold first, right? We think that while prices have run up, we would use any pullback in gold prices as an opportunity to add exposure because, gold remains underpinned by central bank buying, and it also remains, a good inflation and portfolio hedge. However, silver is a slightly different story. So, as you mentioned, silver rally has been partly caused by the short squeeze in London, and essentially, what's happened is that around after Liberation Day, because traders were fearing tariffs being imposed, a lot of silver bars were moved from London, LME's London warehouse to US, and that has meant that the stock of silver in London warehouse has come down. And as a result, there is a shortage of silver bars, if a buyer wants to be delivered the metal in physical form. Now, that has meant that market has gone into backwardation, which simply means that the current prices are higher than prices in future, which is a very, very rare occurrence. And, we are reading reports that the cost of borrowing or leasing silver for 1 month is 30%. And people are, flying silver bars from US to UK. Now, how long does this short squeeze last is anybody's guess. But I think, if we look at the past short squeezes, what history tells us is that, while prices can spike in the short term, in the longer run, fundamentals are the key drivers for prices, right? So we do expect silver prices to come down and edge lower to around $49 or so, by December 2025.
All right, lots to watch indeed. And thanks so much for the insights today, Abhilash. That was Abhilash Narayan, investment strategist at HSBC Global Private Banking and Premier Wealth.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.